Okay, let's get going. So welcome everybody to the Acorn Wealth Corp Finding the Perfect Storm webinar. Now, maybe some of you have actually gone through the introductory video, the short one that was online. Perhaps some of you haven't, so we'll certainly cover all the information that's in that, as well as getting in depth into what we do and go about to find the perfect storm, as it were. Now, as I said, feel free to type in questions into the Q&A or the chat box, and we'll get to them towards the end of the session. So just to start off with your standard disclaimer, you've probably seen 1,000 of these before up on the screen, just to basically talk to the fact stock trading does involve risk, but I'm sure many of you already know that by now, and that's why we're all here. So let's have a quick talk about what the agenda is for today. In today's webinar, basically what I want to cover for everybody is firstly the scope of the hundreds of stock patterns that exist in the market and why you should be ignoring 90% of them. I'm sure this is a very interesting topic on most people's mind, but just because a pattern exists does not mean we want to trade it, and we'll be talking about why. We'll also be talking about how to scan for and identify high probability patterns and weed out the noise using publicly available tools. And I'm going to be sharing those tools with you and actually showing you how we've designed scans within them to identify some of our recent highly profitable trades. And perhaps some of you have heard of those. We'll get to that a little bit later. We'll be talking about these trades, ones we've actually traded with our own capital, some good, some bad. So we'll talk about both. And then at the end, we'll actually go through an extended question and answer session. So as you go through today, or tonight, depending where you are, just take down a pen, jot them down, throw them into the window, and we'll get to those. So basically, for those of you who may not know, we'll give you a brief introduction to who we are. Acorn Wealth Corp was founded in 2007 by myself and a small group of traders that I work with. And essentially, we focus mainly on the technical side of the market with a top-down approach, using some fundamentals to back that up. It was using these techniques that we actually saw the crash of 2008 coming on June 6, shortly after we were founded, as well as the fall of the market during the 2010 in the months leading up to the EU crisis. So there's been some major calls that the technicals, using the patterns, a lot of the patterns that I'll show you tonight we've used to identify these key turning points in the market. So it's very critical how we apply those in situations like that. And due to the success we've had over the last 6 years, we've been featured in Google Finance, Yahoo Finance, lectured at several local universities, and was most recently interviewed on CNN's Money for Lunch show. But putting that aside, let's talk about you, and let's talk about what you're doing, because that's really why everyone's here. How do you make your decisions? And it's usually the same things. It's usually the news, tips from friends. So people giving you the hottest, latest tip of the company they work for, or what have you. Newsletters, advisors, or possibly things that you're familiar with. It's a picture of Vancouver's harbour. But I remember asking this question about several years ago to a group of about 60, 70 people that were in the room, and I said, who here is holding Apple? And then half the group put their hands up, and then I turned to the other half. I said, well, who's here is holding RIM, or BlackBerry as it's now called? And the other half put their hands up. And what was interesting is that if you fast forwarded about 6 to 9 months later, that would mean that half the group were extremely happy with Apple's price rising, and the other half would have been very, very disappointed. So the reason why I asked this question is that most of the time how people are making their decisions is based on emotions, things that are not based on quantifiable things, but in fact emotional reactions to things we hear, which is a lot of the time misinformation. So again, what is your strategy? And this is a question I always ask in almost every webinar and lesson we do, is, if I sat down in front of you and I gave you a piece of paper and a pen and I said, draw exactly what the chart should look like if you were going to buy it or short it, doesn't matter, if you were going to trade a stock or invest in a stock, what exactly would that chart look like? And most people don't know. We'll come back to that. But let's say you did know. Let's say you did know exactly what that chart should look like. What would you then use to confirm that chart? So would you be looking for MACD, RSI, moving averages, stochastics? There's 220 of them, of these indicators. Which of these 220 indicators would you use? And exactly what variables would you use? Is it an RSI over 10 days? Or is it an RSI over 30 days? And if you don't know what an RSI is, that's okay. We'll come back to that. But these are the kind of things you do need to know if you're going to be effective in today's market, especially with the volatility that we're getting today. Because most people don't know this, don't know the answer to those questions, that's perhaps why most people are losing money. A simple question. If you don't know exactly what you're looking for, then how do you know if you found it? And if you don't have a consistent way of confirming that trade when you do find it, how can you expect consistent results? It's like a company going out there with a business strategy that changes every week. You'd never make any money. So again, why do 95% of investors lose money? Well, you know, a lot of it is because of these reasons. They fail to limit losses. So when stocks start to drop, emotions kick in and you keep thinking, well, now it's down 10%, it's become a long-term hold. Who's played that game? I think everyone has. And then, of course, you average down because now it's dropped. You want to get a lower price to make yourself feel better about your position, which, of course, also leads into buying into emotion, believing in public information. I mean, this is a major one, isn't it? I mean, the amount of information out there that is there to mislead you. If you are anyone who's ever watched the news, generally, whenever the market seems to be at its peak, when everyone's the most excited to buy it, is often before it falls apart. In fact, just weeks before this market started to get toppy, the greed index was at its highest. Again, if you think about what the best day to buy stocks in the last decade was, it was in 2008, when I remember the headlines in the paper read "Market Meltdown." That was the best time to buy. And if you listen to the wise old Buffett, as he says, the best time to buy stocks is will be greedy when people are fearful, and fearful when people are greedy. And most public information out there is misinformation. The job of the market is not to help you make money often. Often the job of the news is to create panic. And, of course, if you're a big fund that owns $100 million in a particular company, the last thing you want is bad news going out about it. You want to excite people. Because if you're a fund and you need to get out of a $100 million position, what do you need to do? You need to have buyers to sell to. So the financial system is really, in a sense, there to protect itself. And often that's why most investors get left behind, because we don't have the tools or the access to the quantifiable things that the system is using. And that's what I'm going to show you, or at least introduce you to the ideas of tonight. And, of course, the last two things on this page, we've got selling on pullbacks and taking too much risk. And these are things that are, come back to the charts. When stocks rally and all of a sudden they pull back, people jump out of it. I'm going to share with you a trade that one of my students did earlier in this year and show you one key example of how people lose money in this scenario and, of course, taking too much risk. And this, again, comes back to a strategy. If you're getting into a position and you're buying it at $10 and you don't know where you're going to sell it, then how do you know how much risk to take? If you don't know how much profit you're going to make, how much risk is it worth it? You just don't have that information if you're not qualifying this. And this all comes back to the same stuff: following news, investing emotionally, and lacking a strategy. Consistency is so important, and without a strategy, it's impossible. But as I said, it's not surprising when all of this is out there to distract you. So let's take a different question. How does the smart money do it? Well, the smart money doesn't use tips from friends and things like that. The smart money is actually, in fact, not even humanly reacting a lot of the time. A lot of the time, the smart money is using algorithmic trading. And a recent program on 60 Minutes talked about this. It's all throughout the media. It's not hard to find. They estimate that 70 to 80% of all the trades made in the stock market are done by computers. So this means that there are pre-programmed trades where these literally floors of computers are programmed to buy when a stock hits 10 and sell it when it hits 11. And this is all based on rule systems. Rule systems that are programmed weeks or months before perhaps. And they just go away whirring through these trades, and it creates these technical patterns that we're going to be talking about tonight. Now, despite how scary that might sound, it is very prevalent. In fact, if you look at the flash crash of May 2010, many of us probably remember that. In May of 2010, the stock market plunged in what was later called the flash crash, which, if you remember, there was massive sell orders. The Dow basically plunged 1,000 points in minutes, and then as if it hit an invisible floor, just rallied right back the other way. Now, the only kind of power that can control that type of movement comes back to the smart money. Me or you or anyone in this room, even if we all banded together, still couldn't have even a blip on the amount of movement that was occurred from that flash crash. So as scary as that might seem, these forces that control the market are very predictable. If you think about it, computers are just following the same rules again and again and again, millions of times over. And I use this example in class. If you woke up one morning and you found that the 10 of the stores around your house, the shoe stores, had all had red Reebok shoes stolen, and the police were trying to find out where he was going to hit next, what would you look for? What would you look for? You would look for the next place with red Reeboks. So this is the kind of thing that you need to look in terms of trades. What kind of setups are occurring? And the way we started out, and we'll be covering these, we'll be talking about some stock strategies and option strategies here in a minute, but the way we started out is we started looking at literally thousands of trades that all looked the same. You know, you identify a pattern that looked the same, and what we said was in these 1,000 trades that all had that same fingerprint, that same appearance, what did they have in common? And from that, we were able to reverse engineer and say, in all these stocks, in this, say, 700 stocks that went up 15%, they all had these same criteria. And in these ones that went down, they had these same criteria. And literally, we did millions upon millions of calculations working out what the common criteria or symptoms were. Okay, now we get back to the theme of the evening, which is these stories that charts tell, these types of fingerprints that you can look for. Now to do this, to start exploring the idea of trade personalities, the first step is to understand the core values of what moves the market. And when you understand what the underlying forces are that move the market, from that we can build Forex trades if we were doing that kind of trading. You can do option trading. By understanding what's moving the underlying equities, this gives us the power to build trades off it. And the most fundamental things is horizontal support and resistance, trend line resistance, and moving averages. Now, maybe some of you in the room already have an advanced knowledge of this, but it's often interesting, I find, when I sit down with an advanced trader and I say, okay, what's an ascending triangle? And they say, well, that's a bullish pattern. That means it's going to go up. And I say, well, why? Why is it a bullish pattern? And some people find it difficult to answer that. So let's have a quick look at understanding some of the real basics of what moves the market. And feel free to jump in if there's any kind of core things that you use yourself. See, when we look at the market, I've got my little whiteboard up here, one of the most important things to do is to understand whether we have an oscillating market or stock, or a momentum-based market or stock. Because from this information, Everything else is built out from that in terms of pattern recognition. So understanding the difference between oscillating versus momentum is key. Generally, in an oscillating market or stock, what you're going to see is a lot of this. A lot of basically bouncing back and forth. We can oscillate back and forth in a channel. We could also oscillate back and forth a little bit more like this. This isn't kind of like a triangle. Okay, but just erase those for you. You get channels. But essentially, oscillating is where a stock bounces back and forth between two fixed lines. Those lines could be horizontal, diagonal, as a whole mix. Oscillating patterns, though, are very, very different from how you approach momentum patterns. Let me show you why. Who's ever had this experience before? Who's ever had this experience where a stock comes shooting down all the way down to a support point, and then it bounces up like that, and you buy it? You think, wow, this thing has been falling for a long time. It's a great company. I really like it. And now it's gone up 8-9% in the last couple of days. Looks like it must have reached a bottom. And of course, what do we do? Well, then we chase it. We jump into the stock thinking that it's now time for the recovery, and then pulls right back. I know I've had countless students tell me that they feel that it's almost like the market's watching them, just waiting for them to buy so it can go the complete opposite direction the very next day. And if you've ever wondered why that is, most of the time when I looked at trades like that, it's because people are looking for this, thinking the stock's turning around, when in fact it's just oscillating, it's doing a bounce. And often this can happen for quite a while. So what generally happens is people buy here, and then it shoots back down that 9%, and they're getting out at the bottom, only to see it rally back up the other side. I mean, how frustrating is that? The trick is, if you noticed this was an oscillating pattern, we could have not only avoided it, but actually made money by shorting the stock, betting against it at the top, or in fact, if you're more of a buy type trader, buying there at the bottom. So oscillating patterns are, simply put, kind of looking back and forth between these fixed areas. Now, momentum is different. Momentum, so before we get to that, sorry, in oscillating patterns, the types of things we look for are oscillating indicators. We look for things such as when a stock is, if we're going to buy, really low on the relative strength index. We look for things like stochastics. We use things like Bollinger Bands. And these can all be very good systems of identifying when a stock has reached the bottom and possibly about to go straight back up again. And as an oscillating trader, we would be buying right there at the bottom and selling on the way up. Okay, let's move on. Momentum is something completely different. Momentum is when we have a nice downward drop and nice upward swings like this. And as a momentum trader, there's many different strategies. We're going to look at different strategies for each in a moment. But as a momentum trader, we're not trying to usually buy at the very bottom. We're waiting for it to come up and waiting for that confirmation here. And then maybe it rallies, and we take some profit, and then we buy on the next part of the journey. And longer-term investors might buy and hold for that whole period. But when we're looking at momentum trades, this is very different. The indicators that we would use in an oscillating strategy become fairly useless, and now momentum indicators become the important tests to look for. So moving averages, MACDs, directional movement. And again, there's 220 indicators out there, if not quite a few more. So the list is, it's like picking different ingredients for a recipe that you're cooking. So let's have a look at these different types of patterns that we get in trading, or some of the most common that everyone should be aware of. Okay, firstly, oscillating patterns. Here's some of the common ones you might have seen. Firstly, we have these two bullish patterns. So this is where, when you see this occurring on a chart, we're expecting the stock to rally next. And this is where the stock is pushing up and is actually going back and forth in a downward pointing triangle, or a wedge. And it's, in fact, this pattern is called a falling wedge. So when you get that, the next most likely move is a bullish move. Down the bottom, we actually have the opposite. This is where the stock's actually pointing up in a wedge. So you can see both, kind of like a piece of pizza. And the next move is actually down. And it surprises people, because when they see the stock rallying, they think, well, that must mean bullish. But it doesn't, because the range, because it's getting tighter and tighter in terms of that range, that's actually a bullish sign, or that it's going to reverse. Now, other oscillating patterns, we've also got things like this. This is a double top, also a double bottom. So when a stock rallies up and hits the resistance line like this, and then we see a stock rallying up to reach the same point or a similar point, this is where we can find ideal opportunities for shorting. And I'm going to show you one we did recently, shorting GM. I bought put options on GM, but it was also a possible stock trade as well. Other patterns we have, downward channels, also oscillating, bouncing down in between two fixed lines. The way we want to trade these is shorting them at the top and taking profit as soon as we hit the other side. Upward channels, same thing. And here we're going buying at the bottom and selling at the top. So I want to quickly ask you a question. How many people have seen a channel and traded channels before? Just punch it into the chat window or raise your hand. Yep. Okay. Well, one of the risks with trading channels is picking entry and exits. Of the people that just said yes, how many of people have made money with trading channels, and how many have lost money? So a W for a win and L for a loss. Yeah, I see a lot of mixed and a lot of losers. And there's a good reason for this. Channels can be very profitable. The problem is, as it is with several other patterns we're going to talk about here, is that the market doesn't make it easy for you to make money. Again, come back to the financial system. The market makers, all these funds, I won't name names, but the big boys. You know who I'm talking about. These guys, as trading firms, don't care whether you make money or lose money. So as soon as something becomes obvious, the market is incredibly efficient at making it not work anymore. There's a great book called Wandering Through Wall Street. It talks about the fact if a gentleman's walking down the street in the middle of New York, let's say, and drops a $100 bill, and then turns around 2 minutes later and realizes it, what's the chances that it's going to be there still? Right? Pretty low, exactly. So this market is the same thing. It talks about the efficiency of the market. That's why public information very rarely works. If you figured out that a company, based on the fundamental research you've done, is going to be the diamond in the rough, chances are that somebody else with much deeper pockets, probably a big trading firm like the big boys, has already figured it out first. Same thing with charting. If you see something, usually the reason people like channels is because they're clear to see. the problem with anything that's clear to see usually stops working very quickly. And I generally use what's called the rule of 3. If a pattern has been hit 3 times, then it's generally the end of the pattern. So if you look at this pattern that we've got on the screen, the channel's been hit once on the bottom, twice on the top, twice on the bottom, 3 and 3. So basically at this point, this would be something that I would not even touch. The rule of 3 can really be an important thing to follow. So for those who may have missed, it's when you get these 3 different tests of either end. Now the same thing actually can apply with other patterns, also with, let's have a look here, I'll get my pen out. So if we are looking at, for example, this pattern, which is a descending triangle. Same thing, stock comes down, bounces, 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 and after that third test, you've got 1, 2, 3, and 1, 2, 3 on the bottom. Generally what happens here is you actually get a breakdown. It's a very bearish signal. But by looking at those rules of 3, as soon as you start to see that something is obvious, it generally stops working. And that's one of the problems with a lot of things, is you have to be ahead of the market. You have to be not looking at what's been hitting many, many times over, but what's actually going to happen next, and by creating that plan. And by understanding all the different patterns, and by understanding how to identify them, you can actually predict moves well in advance of them actually happening. So I'll show you this. Here we'll push forward to the next pattern. So with channels, the way that we want to approach these is by actually looking for when they're early in their stages and trying to get them within those first couple of hits. So when you see this, for example, occurring, if you saw this channel rally up, pull down, then rally again and turn, the trick here is actually to connect the 2 tops exactly, and they have to be 2 tops where you know the stock is absolutely reversed. Then simply copy that line and draw an exact replica below it. And all you do is you connect those bottoms, and you'll actually see where that next bottom should be. Now, instead of reacting to the market, we're anticipating the market. Now we get the high probability trade where we get to get in while the smart money's still playing ball and take that next little rally up. And that's a big difference. Anticipating moves instead of reacting to moves. Let's talk about some momentum-based patterns. Momentum-based patterns, when you get well, this one's called a fallen angel, when a stock really just crashes. This is one that we actually traded recently called SNTA, as a pharmaceutical company. Thing tanked from 17 bucks. I think it was around 350 when we finally bought it. And we bought it down here on this little blue button. Now, on that day when we bought it, all of my oscillating strategies were saying it was a terrible buy. And it should have been, because it's not an oscillating trade. That's what they should have been saying. However, all of the momentum indicators, and there's a combination of about 5 or 6 specific indicators with specific settings that I use for these types of trades, and they all lined up perfectly. So it's kind of like a pilot's checklist. If I'm looking for this type of trade, I'll go through my 5 or 6 different tests, and if all of them are saying yes at the same time, then I know I've got a fallen angel trade. And so we bought that at, again, about 350, and we sold it up here, and that was just under $6, I believe, and then we sold the other half of it up here around 7. This, again, was an options trade, as well as a stock trade. Other types of momentum patterns. This is called a bump and run, and this was on another different stock called ARCO. And this, again, has a different personality. So on this stock, the way we will identify this is with a different set of criteria, different indicators. And this stock you can see is called a bump and run. It's also can be called a scallop. Kind of looks like a, if you see this on a chart, it kind of looks like a spoon. So you can see this, how the top part, kind of like the handle, and then you get the spoon down the bottom. And when you see that, this is also a highly profitable pattern if you know how to trade it. And there are a few ways to trade it. The first way can be buying it as soon as you get that support level. You can see here we bounce once, then we bounce a second time and create a double bottom. That can be the first one. And the second one, second entry, is once it breaks this resistance. So this is one of the keys with a bump and run formation. What you'll see is if you connect all these peaks, it runs this line straight into where resistance is. And as you can see here, the stock rallies up, hit that resistance, and then pulled back. Once it broke that line, this was your momentum trader's entry. So two types of trades here, actually, in fact, guys and girls. There's your first entry. And there is your second entry. Has anyone traded at something like this before? Or has anyone traded? No. Now, it works really, really well. And the thing about it, what I wanted to get to by kind of running through these different patterns with you, is to get you to see, get you to understand that with all of these different patterns, each one has a different methodology. A different methodology of how we find it, a different methodology of how we trade it. And with that comes different percentages of probability in terms of how likely is it that it will go your way. How much profit should it make when it goes your way. And also, and this is important, how predictable is it? So how easy is it to actually find the chart? One very, very highly profitable and highly consistent pattern is flag formations. Flag formations can make an absolute killing. They can go up 20, 30, 40% sometimes in days. But often some of the problems that traders have are identifying it and also picking the right entry point. And on that, I'd like to talk about one final pattern. Let's have a look here. Now this is an ascending triangle and a rising wedge. Both of these breakout patterns. So in the audience, I've found that this is often one of the ones that people struggle the most with, is because it's one of the most sought after patterns is breakouts. But how many people have had disappointing losses trading breakouts, or perhaps the better word is frustrating losses trading breakouts? Yep. And of the troubles that you have, what are some of the common problems that you've occurred? Just throw them into the chart window. Some of the problems you've ever had trading breakouts. The issue that we often find with breakouts is this. They're very easy to trap traders into. I'm just going to throw a little drawing up here next to Stewie let's say that you've got a scenario like this. Let's use a flag formation. Let's say that a stock is bouncing along the bottom, shoots up, breaks out, and then comes back down and looks like that. Okay? That's kind of your breakout formation. Now, I noticed that one of the things that someone's commented is high-frequency trading coming into the market, and that's absolutely right, Dwayne. That is exactly one of the problems. So how do we scan for and how do people get trapped for in these types of scenarios? Well, firstly, with breakouts, let's talk about the first problem. With breakouts, the first problem people can have is traps or fake outs. Something has really rallied up, let's say, and then pushed. It starts to break out and then crashes. So in other words, it was a fake breakout. And one of my colleagues who used to trade for about 40 years, ran a commodities company here in Vancouver, he always used to say, you always go broke trading breakouts. And the problem is because of this fake moves that you can get. So one of the first things that I've always looked for in breakouts is understanding volume. When high-frequency trading comes into the market, a lot of the time, high-frequency trading will manipulate a stock's price to push through its resistance so that they can create buying from the retail traders so that the professional traders can sell to them. And by them, I mean you. They are manipulating the stock to encourage you to buy so they can sell. And then what happens is the stock rallies up a little and crashes. So the first thing about breakouts, whether they're horizontal resistance lines or diagonal lines, is to always wait for the retest. So when you see that break through the resistance, don't chase it, because by then it's probably already up 5, 6, 7%. What we want to do is we want to wait for it to come back down, and then when it hits the support, that's when we buy. Because you know what? If we can buy right there at the support line, we get in with much, much less risk because we're buying close to support instead of when it's already up 7%. And we also get an opportunity to see if it actually just comes back down and breaks straight through, meaning we also avoid a lot more losing trades. That's one of the first things. The second thing is to understand volume. One of the questions earlier was, how do you identify a flag? Well, it's the same answer, or it's the same symptoms as how we avoid breakouts. Understanding volume is key, because all these high-frequency trading companies and all these smart money that I keep talking about, they're out there to make money. So when they manipulate stock, watching the volume and understanding the patterns that these smart money buys in, a lot of it will show up in the volume. So with a flag, one of the critical things to look for is that when the stock breaks through the first resistance down here, what do you think we're looking for? What do you think we're looking for at that moment when the stock breaks through? Any guesses? Bingo. Large volume. And knowing what type of volume is key. How many shares? What type of volume represents different types of buyers? Things like terminology like iceberg orders and things like that. Just knowing some of the basics really show you where that the smart money or the market makers are tipping their hand. Because if something's going up and volume doesn't accompany it, then watch out. Or potentially wait for an opportunity to go counter trend and make some money surprising when the thing falls apart. These are great techniques. When you can start to look for divergence like this, there are some awesome strategies which we've used in the last 6 years to identify major movements. When we shorted Apple last year, that was based on looking for this type of divergence in volume. Major market moves, seeing when the smart money is pulling, pushing in or out, and you guys are absolutely on the money. You've got it. It's volume. So understanding volume patterns is just as important as understanding stock patterns. Okay, let's push forward. So understanding what goes into a trade and understanding what the probabilities are crucial. Okay, so I've just covered quite a few different patterns in this short amount of time. The most important point about that is that you don't need to know them all. And in fact, trying to know them all is where most traders go wrong. You would not, if you went to a restaurant and they had 100 different entrees on the menu, what would you think about that? I know I wouldn't be very impressed because I'm probably not expecting a very high standard of food. Whereas if I go to a restaurant and there's maybe only 5 things on the menu, and you know that when you say, well, what's good? And they say everything, because we only do the 5 things we do best. That's the kind of restaurant I want to take my wife to a nice dinner at. And it's the same thing with trading. A trader has to specialize. There's over 100 different patterns in the stock market, if not more, but 100 popular ones. And every single one of them has a different way you find it, different indicators you use, different tricks, different traps. And it's just like cooking. Each thing has a recipe that you need to follow. Trying to be good at all of that is useless. It just you end up wearing your wheels and you get no consistency. So for us, when we go out to do trades, the trick is to say out of all of those 100 and somewhat patterns, which ones are going to be, think about the 3 Ps, the most probable, the most profitable, and the most predictable. And the final thing that goes on top of that is risk-reward. So let's say you've got those 3 things in play. You also want to make sure that you're able to take trades where if you're wrong, you lose very little, but if you're right, you stand to gain a lot. And that all comes back to stuff we talked about, like the breakouts. If there's a stock that's range-bound and it's bouncing, if you wait for it to get to there before you buy it, you're taking this much risk for this much reward. That's what people who react to the stock market do. When we are anticipating the market, we buy at the bottom. We buy when the stock is actually going down, and we sell when the stock is going up. There's a hell of a lot more that goes into that, and it looks like you're all catching on, so I'm sure that makes sense. The ingredients that go into a scan, 3 things: a trigger, conditions, and indicators. Okay? Triggers. What that is it's why you're interested in the stock in the first place. So if I'll give you a little tip. If I'm going to be looking for a stock that is at an extreme level, so I'm looking for something that has came all the way down and is about to rally up, hopefully. What I'm looking for, one of the things I'll look for is I'll look for a relative strength index, which tells us whether the stock is relatively strong or weak, based on how it's been moving recently. I'll look for a relative strength index over 8 days. Okay? RSI 8. And what I want on the very day that I buy it, the reason I'm going to buy it today as opposed to yesterday, as opposed to tomorrow, is I want the stock to be below 20. Okay? The next thing I would look for is I would look for the stock to be outside of the Bollinger Band. There's a special setting we use for the Bollinger Band. We use a 20-day with a 2 standard deviation. Okay? Now, the final thing that we want to then look for is we look at things like CCI and other extremes. So with all these different things put together, what we get is a high probability trade from the triggers. The next thing we go to is conditions. So the reason why I might buy it today is because the RSI is down. However, I also want to have other conditions. So conditions will be things like a certain index. So we might want the stock to be within the manufacturing index. We also want to be looking for things like, for example, if I'm shorting a stock, we might be wanting to look for a high P to E ratio. Other things that we might want to be looking for is insider selling. Now, these are all conditions because they're not happening today, but they're present in the background. The final thing that we then want to look for, that what we need to build into our scans, are indicators. So depending on the type of trade, what we need to be building are certain indicator settings. So again, I'll give you an example of how I found some of our recent shorts. And this is using a scan usually in option season. What I would do is I would look for stocks that were, I saw that the market was toppy, was high, so I was looking for the downside of any surprise earnings. So I built a scan which had the relative strength of 8 really high. So I was looking for it to be above 80 instead of below 20. Next thing, looked for volume that was going down. So price is going up, but volume is not accompanying it. Those were some of the triggers. There was a few others, but this is one of the basic ones you can take away with the news. The next scan, next part of it, P to E ratios that are above a very high level. So looking at like 100 plus, 200 plus, high P to E's. I'm then looking for resistance, looking for the stock to be heavily at a resistance zone. So right up here. Then, for other conditions, looking for insider transactions to be going down, institutional transactions to be going down. And then once we've done all of that, then there's about 4 indicators that I'll use to confirm this underlying weakness is supported by the technicals. And if all of that lines up, we have a trade. And using that strategy, we were able to identify shorts on GM, which is the options on that actually went up 100. The put options went up 100% since we found that. And we also had a few others. I'll just go through those in a minute. But that's one of the strategies that can really make an effective impact on your profitability. Now I'm going to go through and show you how to build that scan once we get to the question and answer period. But I'm just going to quickly finish up some of these different slides for you. So once you've got this consistency, you can keep looking for the same trade again and again. And what I do is every night as a trader, I'm scanning the market using the 3 or 4 scans that I have found to be the highest profitability and probability and predictability. So each night when we run that scan, it goes through and analyzes the entire market in seconds and will tell us exactly what stocks meet our list of criteria. So instead of having to go through thousands of stocks and taking hours and hours, I can run my scan, and within about 5 to 10 minutes, I already have narrowed the market down to about 3 to 4 potential trades. What I then do is spend about 10 minutes reviewing those 3 to 4 trades, going through my pilot's checklist and deciding which stock meets all those criteria, and then that's the one I'll go for the next day. So when I wake up in the morning, I know exactly what stocks I'm going to trade. I've detailed exactly what price I'm going to buy them at, exactly what price I'm going to sell them at, and where I'm going to place my stop loss. So I now have a plan. There's no guessing, no stress, hopefully, unless I'm having an argument with my wife or something. But there is, it's basically a method there where you go through and you know what you're doing, and that is incredibly much more satisfying than staring at the screen, waiting to react to the next thing that's going to happen. Plan, and that is one of the key things. And so this is another one of those trades. American Express, same type of thing. It was up to heavy resistance, heavy institutional trading, heavy insider trading, and just as it hit that resistance, that's where we called the short on it. And then immediately after, straight down, and our area we wanted to get out was once again $74, because you can see that was the last place it bounced off. So we know exactly where our entry is, exactly where our exit is, and the beauty about that is when you know exactly what you're doing because you're following a strategy, you can actually program that in to your brokerage account so that you don't even have to be there when the trade happens. Now that's the key thing, trade to live. So I'll just finish up with here, then I'll go over to the Q&A in a minute. When you're trading to live, just like running a business, you should always have a strategy. Your strategy should be making money work for you while you're enjoying it. If you're spending hours stressing and not knowing what you're doing, and you're in a stock that's profitable and you don't know whether you should sell or buy more, then you're not trading with a strategy. You're emotional, and this is always going to lead to inconsistency in the end. It's not about making $1 million tonight. It's about being wealthy long term, and that comes from strategy. This is actually one of the photos of me enjoying time while the market was open as an aggressive trader. So just because you can be out there enjoying your life doesn't mean you're not making a lot of money in the market or enough money in the market. It just means that you have used effective strategies to manage it for you. Now, what are the next steps? I know we've covered quite a lot of information. Basically seek help and education. As I said, the trick is not to be an expert at everything. It's about to be able to specialize in just at least one thing. So let's say that your one thing is flag formations. Then let's help you become an expert in that. And for the next 6 months, don't trade anything but flag formations. And this is a smart bunch of people, I can tell. Everyone's been on the money. Learning one strategy, no matter how advanced you are or aren't, is often the trick to consistently profiting. And there are strategies that are obviously easier than others. And what we do, our goal is to make you a confident trader that consistently produces profit in any market. Now we have another training session that we'd like to invite you to. We're just going to go through the details of that. It's next week. And then once I've gone through the details, I'll take some questions and go through a bit more of that review. So next steps. The class next week, what it covers, essentially is a lead up to September through December. September through December, for those of you who haven't traded in these months, is usually the best time all year. Mid-January through to mid-April is pretty good. It's a close second. But September through December always been where we've made the best returns. The best performing period we've ever had was October to December through 2008. So it was very volatile, as you know, and also those months have also been consistently good year in, year out. So we've got a plan for that. And it's basically where we make most of our money. And so what we're going to be doing in preparation is actually doing a special 2-hour workshop, which will break up with a chance for everyone to grab a coffee or an orange juice in the middle of that. We'll break it into 2 1-hour sessions. It'll be next week. And what we'll be doing is focusing on some specific scans. Obviously, it's too difficult in an introductory session to cover over 100 scans, but what we will do in this next session is actually drill in and focus in on some of those higher performing strategies that we use. We'll be looking at the ones that we've been using on the trades I've been discussing with American Express and GM. Those are two specific trades we'll discuss. I'll also be talking about the one on SNTA, where that was that fallen angel trade that went from about 350 to 5. We're going to be talking about those. We're going to be also going through, obviously, and focusing on what strategies we've found work the best going into this highly tradable market. We'll be covering, obviously, the reasons we've touched on today, such as the rule of 3, when patterns start to work and stop working, how to anticipate the changes in the market instead of reacting to them, the differences between triggers and conditions when building the scan. So we'll be getting in and really building out a couple of core scans that you can use. We'll be going more in depth on those breakout trades, focusing in on the double tops and double bottoms and flags. But the main focus is to have you leave that session with 2 highly profitable, highly probable patterns you can go away with and help you build those out in your own platform. Okay, so that's essentially what you'll be leaving us with. To register, it's $29 for the 2-hour workshop. It's actually, if you go on our website and review the trading boot camps, it's normally $499 for the module that we're offering. It's something that we've been doing for this one time only. You can register at HTTPS, so S for secure, https://www.acornwealthcorp.com/stock. You can also contact us at info@acornwealthcorp.com or use the phone number 1-877-272-2676 to contact the office. But this should be an excellent opportunity to really drill in and get a handle on a strategy you can feel confident about. There's nothing worse than looking through the market and not knowing what to be doing and to feel paralyzed, I think is the best word one of my students once used. To feel paralyzed of not knowing what to do next because you don't have a plan that's based on proven rules and proven strategies. I see a couple of questions coming in. Okay, so yes, the session next week will be recorded. Okay, so we will be recording the session so you can actually review it as many times as you want. We'll be providing you with PDF documents, which will give you, as I mentioned before, a trade checklist. So for each of the strategies which we'll be teaching you, there's a specific scan that we've developed, the proprietary scans that we developed, which we can help you program into any of the systems you might be using. The system that we'll be teaching you on is using a program called Untitled Chapter. And for those of you who are on Mac, we will be teaching you on TC2000 or freestockcharts.com. Both of these are actually complementary programs you can use to scan the market. What you'll also have access to is full Q&A, both in the session and after the session as well, so that if you have any questions that you need answering, myself and the coaching team will be available to you to make sure that you truly leave that 2-hour workshop knowing exactly how to apply it into your strategy and into your portfolio. So no matter what trading platform you're using, these can be programmed in. And yes, Marcus, I use these stock scans straight off the net every day, so it definitely works in your favor, no doubt. It's when you know what to look for, there's a thing that the terminology you'll get used to when you finish this workshop. It's called the blink test. The blink test is something that we use with all of our students to say that if you're looking at a chart, and you've analyzed that, and within about the time it takes you to blink, you don't see exactly the trade that you're looking for, move on. If the trade isn't obvious, if it's not exactly what you're looking for, and again, we use the time it takes you to blink, then it's too tough. That's what having a scan does for you. You can search for these perfect opportunities. No, Mary, I don't. In terms of futures, Mary, we wouldn't suggest that you use the scans for futures. The futures can be a bit of a different ball of wax. We do watch the futures as an indicator, as all professionals do, but we are teaching you how to cherry pick the stocks and opportunities with high probability entries, exits, and stops. Stops are critical. Stops are critical. So again, we're looking for that perfect opportunity. So out of the thousands of stocks on the market, the amount of companies that filter through and meet all of our criteria on a given day might only be about 2 or 3 or 4 that have that perfect storm. Again, the public software is, we use FinViz. Incredible charts are the two main things, techniques we use in the scanning. Yes, we will teach on how to scan for flag patterns, absolutely. Flag patterns, again, it's about finding those cherry pick opportunities. So on some days when I run my scans, I actually don't find anything. And that's important to do as well. Being a long-term successful trader isn't just about knowing what stocks to trade. It's also about knowing when not to trade. And if I run my scans, and there's about 4 key scans that I'll be sharing with you that I myself run every day, and if I don't find stocks that jump out to me that are exactly what I want, using the blink 10 ideology, then what that means is the market's telling me that there aren't any good trades. And that's an opportunity to sit out. Bollinger Bands. Yes, we use Bollinger Bands, RSI 8 period, and we use it on a daily chart. However, one of the beauties about going into this strategy is the strategies we teach you in the scans are actually applicable for both the daily and intraday. It's kind of like one of those Russian dolls, you know the ones where you have that wooden Russian doll and you open up the big one and inside another smaller one, and you open that and so you've got this tiny little Russian doll sitting on your desk. That's like about how we approach the market. Each of the scans and strategies we show you will be applicable on multiple time frames, and we'll illustrate that on each. But yeah, I mean, I'd highly recommend you come along. These are strategies that have literally taken me, or built up and taken me over the last 10 to 12 years to design. As you can see, when you've got hundreds of strategies, hundreds of indicators, and perhaps even more difficult, so much garbage and so much noise out there, it takes a very long time to eliminate all that noise until you finally land on something that makes you successful. I've had the ability to do that because I started young. I devoted many of my younger years into just doing nothing but analyzing chart after chart. I spent many years after that working with and talking to funds and professional traders that shared with me some of the things that made them successful that have taken them 10 to 20 years to learn. And so over the course of my trading career, I've been able to pull from all these resources and have the time to devote to it. I think a lot of people don't have 12 years to analyze the market full time. They usually end up feeling defeated, or they run out of money, or maybe a combination of both. What you'll be learning in this lesson is some of these core strategies that I now use as part of my own personal trading portfolio every day. I'll be showing you some of these different trades that we've done in the past. We'll also, at the end of the session, be doing a live analysis of the market. So yeah, it's only 29 bucks, and if you come away from that learning just one pattern that works well for you, and you can spend a couple of minutes a night using that scan to find stocks, I'm sure if you value your time at more than 28 bucks an hour, you'll find it worthwhile in the long term. I'm sure you'll get a lot more than that, but it's certainly important to be efficient. So again, once more, the link there is acornwealthcorp.com/stock. And make sure you put the HTTPS in the front. You should see the link there in the chat box. So again, the workshop is on August 28th from 8 to 10 Eastern. It will be recorded. We'll make that available to you right after the session. And if you register and you cannot be there, again, we will send you the link. Now, just important, the offer, because of seating available in the webinar, is limited to the first 100 attendees. So if it's something that you want to be doing, please get on as quickly as possible, fill it out, and make sure you include your email and information so that we can get those recordings out to you. We've certainly enjoyed the time you've spent with us tonight. We appreciate spending your evening with us. I hope to see you all next week. So thank you all, and good night. Happy trading.